Hello, and welcome to Virtual Investor Conferences. My name is Cecilia, and on behalf of OTC Markets, we're very pleased you've joined us for our next live presentation from Giga Metals. Please note you can submit questions for the presenter in the box to the left of the slides. You can also view a company's availability for one-on-one meetings through the Schedule Meetings tab found on the conference platform. At this point, I'm very pleased to welcome Mark Jarvis, CEO and Chairman of the Board of Giga Metals, which trades on the OTCQX Best Market under the symbol GIGGF and on the TSX-V under the symbol GIGA. Welcome, Mark.
Well, Cecilia, thank you so much. It's good to be here. One correction, I'm no longer chairman of the board. Longstanding board member Lyle Davis has now become chairman of the board. I'm still a board member, I'm still CEO, but we decided to split those duties as simply better corporate governance. So I'm going to be talking today, for the audience out there that's already familiar with the project. I'm not going to go into a huge amount of detail about our particular project, just enough. I'm mostly interested in talking to you about the nickel market itself, the role of EVs, and then the elephant in the room, which is Indonesia. So with that, I'll just get started here. And here's the standard disclaimer. So we are a publicly traded company on the TSX-V, that's Giga Metals, and we hold 85% interest in the joint venture company, Hard Creek Nickel, and our partner in that is Mitsubishi Corp. They got involved, almost 2 years ago now. And then with them, we completed a pre-feasibility study in October of 2023. And currently we're planning next steps. So just a few highlights. We're looking at something that in a typical year will produce about 35,000 tons of nickel and about 2,000 tons of cobalt. That is a giant mine. It's got a big capital cost, US 1.9 billion, but for a 30-year mine life. And our site operating costs, we can produce concentrate at the site gate for about $3.85 a pound. And then if you work in transportation, processing fees, and also byproduct credits, that turns into a C1 cost of $4.65 a pound nickel. And that's a good number to remember. The concentrate we make is a beautiful, clean concentrate, 18% nickel, 1.1% cobalt, and we can produce this reliably, we've demonstrated, from every part of the deposit. Our flow sheet is very simple. Of all of the large, undeveloped, low-grade, open-pittable nickel deposits in North America, we are the only one that's purely a sulfide deposit. All of the other deposits are either ferronickel or they're some combination of sulfide and ferronickel. This makes our flow sheet the simplest of all the projects in North America, and therefore the least risky. Less steps, less operating risk. And we've, as part of the PFS, did an extremely successful geometallurgical program. What that means is we can look at every part of the deposit, every grade, every rock type, and we can very accurately predict what our recoveries will be. That is also very much reduces the risk of the project, and that's what this engineering process is all about. And then as a large open pit mine, it's an extremely important economic factor that our strip ratio is exceptionally low. 0.4 tons of waste we have to mine for every ton of ore that we put through the mill. It's also extremely low carbon operation, and we think we've got a path to carbon neutrality with this project. Located in north central British Columbia, It's a mining-friendly jurisdiction. We're in the traditional territories of both the Tahltan and the Cascadena First Nations, and both nations are traditionally quite welcoming to the mining business, provided that you're prepared to act responsibly and with respect. And we are prepared to do both those things, and we have been conducting ourselves in that manner. So here's our reserve statement put up as part of the PFS. We've got a total of 950 million tons of reserves. And that's the basis of a 30-year project life. And this chart shows the production of nickel in green and cobalt in blue for the life of mine. So there's clearly some variability. I mean, we get up to almost 45,000 tons of nickel in some years, and down to 30,000 tons in other years. But as a typical year, we'd say 35,000 tons of nickel per year. So that reserve is a subset of the resources that we've drilled off. We've got a total of 1.5 billion tons in the measured plus indicated category. And we've got a further 1.1 billion tons in the inferred category. So, this 30-year mine life, we've got a lot more work to do to prove that we've got a longer mine life than 30 years, but clearly geologically, the resource is there. And then beyond the resource is mostly in the Horse Trail Northwest and Duffy zones. In fact, that's where all of the reserves are. And yet this whole ultramafic is underexplored, and most of it we consider highly prospective. So up in the Highland Zone, we've got drill holes that are very similar to what we've got in our reserves, and that's about 4 kilometers away from where we'd have the open pit. We think we've drilled off about 20% volumetrically of what we consider prospective within this ultramafic intrusive. So what I'm trying to say is that this is really, really big. And once we get it up and running, it could run for many, many years. The concentrate is a beautiful, clean concentrate. It is suitable for smelting. And in fact, it's a very desirable product for a smelter because of its grade and its lack of deleterious elements. But it is also extremely suitable for direct pressure oxidation. So if you wanted the most efficient route to the battery cathode, it would be take our concentrate, put it through a pressure oxidation process. You could create either mixed hydroxide precipitates, which are easy to ship and easy to store, or you could directly produce sulfates if you had your pressure oxidation circuit set up beside your PCAM plant. That would be the most efficient route of all. And we've modeled selling to a smelter because that's the market that exists. The pressure oxidation refinery market is smaller, and not too many of them are taking outside feed sources at this point. So it's a market that we think will emerge over the next decade or so, and perhaps become the predominant market, but it's not there as we speak today. So let's talk about the current global nickel market. And I'm going to be talking about a few things listed here. The recent drop in nickel price, electric vehicle demand, mine closures, and Indonesia. So here's a 40-year chart of nickel prices up till 2023. And the black line is in inflation adjusted dollars, so 2023 dollars. And the brown line is, the dollars at the time. But you can see, the important line is the black line, obviously. And you can see how volatile nickel is and how every so often it just goes crazy and then goes back to the baseline. So, despite the current bad nickel market, my guess is we're due sometime in the next 5 years for something like this. But this is the market for the last year. And this has really hurt us. It's affected our stock price, obviously. We're very sensitive to the price of nickel as a project. Um, and it's kind of slowed things down. And it's all because of, things have gotten overbuilt in Indonesia, and we're in oversupply for probably about the next year, maybe a bit longer. Um, but demand keeps growing. And so we'll get into that as well. So at current prices, um, we're in a place where it's around 750 a pound US, and about 40% of producers are losing money at these prices. So, that's not sustainable. In the short term, nickel can do, anything. But in the medium to longer term, whenever you see something like this trading at a price where so many producers are losing money, that's the bottom. It doesn't give you a timing of when you get out of it, but that's the bottom, because you'll start to see mines closing down. And in fact, recently, BHP Billiton announced that they will be shutting in all their nickel operations in Australia. That's 80,000 tons a year of nickel coming off the market. I think overall that's healthy for the market. And I want to point out that these are legacy assets. So you've got old mines, and the old mines, it's ever deeper, ever worse grade. My understanding is BHP has been losing about 300 million a year on their nickel operations in Australia. Um, so these are not high quality assets at this point. They were. Mount Keith was a very successful mine, but it's played out now. They're using Yakabindi as their ore supply now, and Yakabindi has an extremely high strip ratio. So, and similar things could happen with some of the other 40% of producers that are losing money right now. Some of them are in Indonesia, by the way. So, but I want to point out that at our C1 costs, if our project was up and running today, we would not be losing money at current prices, okay, just on an operating basis. Now, that said, we've got a $1.9 billion US hurdle to overcome to get into production. But I'm just saying, if we were built and operating, we would not be one of the ones that was losing money today. Now, there seems to be a narrative out there that the EV story is over. And so I just wanted to present these two slides on one page. This is from a recent report by Macquarie, and very data driven. So May to May, last May to the May before, global EV sales were up only 19%. That's still that's lower than the year before, but it's still a blistering growth rate. And, the compound annual growth rate for EVs has been 50% over the last 10 years. That is a crazy number. And it's not sustainable. I mean, obviously, at some point, the hockey stick curve rolls over and becomes an S curve, and gradually the compound annual growth rate has to slow down because it's mathematically impossible for it to continue. But nonetheless, we're still in a period of very strong growth. 19% ain't bad. But you're hearing all sorts of news about how Ford's, producing more gasoline powered engines. And I think a lot of the car makers jumped in too quickly and they were unprepared, and they're paying the price for that. But that doesn't mean that demand is slowing down. And so that affects nickel. Some of the battery chemistries will be LFP. That won't involve nickel. That's all part of the equation. But certainly the premium brands and the brands favored in North America, for example, will call for range. And nickel is the key to range in terms of battery chemistries. So, based on that, the forecast for demand growth for nickel in batteries is quite strong out to 2023. There's an incremental 770,000 tons a year of nickel demand that's forecast just for batteries. And that's not accounting for the steady growth of stainless steel and so forth. That is the equivalent of 22 large nickel projects that need to be built between now and 2030. And so it's still very challenging to meet that demand from the supply side. My point is the EV story has not gone away, and despite what you may read, the data don't support that. Now, here's the elephant in the room. Part of the reason nickel prices are low right now is because Indonesia and the Chinese have overbuilt in Indonesia. And, some of the production's cheap. I mean, the nickel pig iron used to supply the stainless steel market is cheap. But not all of the production in Indonesia is cheap. And there are Indonesian producers losing money at current prices. So, but the other thing is, if you look at the mining practices in Indonesia, it ain't pretty. And it's environmentally, I think it's a disaster. And, it's stripping down tropical rainforests in many cases. There's pollution. And yet, the environmental or the electric vehicle business relies on Indonesia. It's hard to find a brand that doesn't have Indonesia in the raw materials mix right now. And so if you think you're saving the planet by buying an electric vehicle right now, think again, because if it's got Indonesian nickel in the supply chain, there's a lot of problems with it. Deforestation, water pollution, marine ecosystem damage. A lot of these operations just dump their tailings into the ocean. Pretty cheap, very competitive economically, but that's not good for the environment. Air pollution from coal, and then there's social impacts. It's the Wild West right now, and the rights of the villagers are being trampled on. The rights of indigenous people are being trampled on. I suspect, Indonesia is quite high on the corruption index, so you can draw your own conclusions about that. Some people are making money, and other people are getting walked all over. So Indonesian nickel production is problematic, put it that way. And polluting, this is the Morowali industrial park. And to me, this looks like Mordor. But it's a big nickel processing facility. And by the way, I don't think I mentioned, but there's a history of industrial accidents and workers losing their lives working in these facilities. It's not, it's not a culture of worker safety by any stretch of the imagination. And there's just some pictures of deforestation, pollution of rivers and coastal waters, and contaminated drinking water. So, one of the things that's contaminated is chromium-6, which, if you ever saw the movie Erin Brockovich, that was the chemical that was causing all the cancer, and that Erin Brockovich and her team fought a successful lawsuit over. So, anyways, there's the point. Our project is different because we have to go through a rigorous environmental assessment, something that doesn't really have to be done in Indonesia. We've adopted in British Columbia the United Nations Declaration on the Rights of Indigenous People, and we live by that. It involves communication and collaboration with the local communities and the indigenous people. Um, Ours is a low carbon operation as compared to Indonesian nickel is ranges from high to extremely high. Um, an open pit operation, yeah, it's a big hole in the ground. You can't uh, have a mine without an environmental impact, but it's it's a deep hole in the ground, so it doesn't spread out. It's not like a strip mine in Indonesia. It doesn't go mile after mile. It goes deep, and so the amount of impact, environmental impact, relative to the amount of material that you're moving, is relatively small. Um, and we're using a modern tailings management facility, which is not inexpensive. So, you know, uh, we're doing things the right way, and that does cost more money. And this is just something showing the carbon intensity. So we're doing things the right way, but does that mean we're economically uncompetitive with Indonesia? Well, we had our engineer do a study, and there's a lot of information on this slide, but the next slide is a relatively simple chart where our engineer took all of our 43101 compatible information from our pre-feasibility study and then gathered up as much information as he could on other HPAL projects, high pressure, high temperature acid leach projects that are our competition for battery material in Indonesia. And both Western HPAL projects and those that are built the Chinese way. And so I just want to caution that it's hard to gather this information. The Chinese are quite secretive about their costs, but our engineer has excellent sources. He's conservative, and he has done a very careful job of gathering information. That said, it's not easy to get all of the information. So I just want to caution you that. And here's the result. Here's the economic comparison. Now, this economic comparison is corrected to, projects that are about the same size as the Turnagain Project. And what we do is this is a cumulative cash flow model, which is the best way to do a comparison. It strips out a lot of extraneous information. So you start off um, with negative cash flow because you're building your project. So this is assuming all these projects start construction at the same time. And then you can see that the Western built projects, and he also included currently operating a mine, Ramu, but he assumed that you're going to actually build it today. And he's, because he knows the capital cost of that project, and he's inflated them to today's dollars and the operating costs. He's got some pretty good information on that. So we compare well to that. We compare to the Western HPAL projects, and then the Chinese, as best as we can tell, with all the corners they cut, dumping tailings into the ocean, just careless about worker rights, very low paid workforce, all of that. We're still competitive. If you look at the green line, it's similar to China Incorporated. They start to beat us after about 11 or 12 years because they've got a higher cobalt content. But still, this we are competitive. And so there is absolutely no reason this project can't get built. Um, anyway, so that is that is our take on the market right now. This is our plans and catalysts, and I've left the dates blank because it all depends on when we get that next big round of money. We are in active conversations with potential strategic investors. This is our board, a good, strong board, and I am ready for questions. So I just push this button and get the questions. Can you speak to your plans and catalysts for the next 12 months? Money, money, money. We're looking for money. And so that will be the main catalyst, is if we get a strategic on board, a new strategic on board, that would kickstart all of our operations. So that is the main thing. Another question. Given all the mine closures in 2024, why would an investor choose a junior mining company like Giga to invest in? Well, that's a good question. The reason is we're a new mine. And so we're not an old mine reaching the end of its life, chasing ever lower grade material ever deeper. We're a new mine. And we, once we're built, could survive the current price environment. We frankly need a bit of a higher price to get this project built. But if 40% of producers are losing money, it's the old saying in the mining business is the solution to low prices is low prices. Mines will shut down. The supply will go away. But we would make it if we were built. Are we eligible for government grants and funding? Yes, and we will become more and more eligible the further advanced we get. But we absolutely fit with what the U.S. government is looking for, but also what the Canadian government is looking for. In particular, the Canadian government, we think, will step in when the time is right and help with the infrastructure. They've got a $1.5 billion investment fund specifically for infrastructure, specifically for critical minerals like nickel and cobalt. And that would be the power lines and the road. And that would save us somewhere between $250 and $300 million off our CapEx, which would really help our internal rate of return. Another question, isn't the 11% IRR just barely above the minimum needed? Most IRR in pre-studies end up being lower when in operation. Well, it depends. The IRR required depends. If you have like a high-grade gold deposit with a 7-year mine life or an 11-year mine life, you need a really high internal rate of return. Base metal deposits, particularly those with a mine life of 30 years and more, the threshold is lower. And I just want to point out that our study is extremely conservative in assumptions around sustaining capital. We assume that our mining sustaining capital is 3 times higher per ton than a lot of the other studies that are out there with competing projects. Our sustaining capital for a ton put through the mill is like 8 times higher per ton. These are conservative numbers. And, so they don't flatter the IRR, but we think our numbers are realistic. And our marketing assumptions are conservative and realistic. So, the thing about base metals is if you can get them into production and if they're capable of making even a small profit at the low end of the price range for the commodity, well, then when prices increase, as they do from time to time, this is true of all base metals, but particularly for nickel, which is volatile, you absolutely make a killing for 2 or 3 years, and then you go back to making a simple living. So I'm getting a message that we're about to shut down. I look like I've used almost my whole 30 minutes here. So I just want to thank all of you for attending. If you've got any more questions, you can contact us, and I'm happy to set up one-to-one meetings for people that are interested. With that, thank you very much, and see you next time.